Namaskar. This was the 50th meeting of the Monetary Policy Committee since its inception in September 2016. The flexible inflation targeting framework will soon complete 8 years of its functioning. The framework has worked well in maintaining macroeconomic stability even during times of extreme stress. Its embedded flexibility has withstood the pandemic-related stress, the spillovers from the war in Ukraine, and the continuing geopolitical crisis that we face today. Today, while India's growth remains strong, inflation is broadly on a declining trajectory. Strong macroeconomic fundamentals of India have also led to greater confidence in our economic prospects. Let me now turn to the decisions and deliberations of the Monetary Policy Committee meeting, which met on 6th, 7th, and 8th of August. And it goes as follows. The Monetary Policy Committee met on 6th, 7th, and 8th August. After a detailed assessment of the evolving macroeconomic and financial conditions and the overall outlook, it decided by a majority of 4:2 members to keep the policy repo rate unchanged at 6.5%. Consequently, the standing deposit facility rate remains at 6.25% and the marginal standing facility rate and the bank rate at 6.75%. The MPC also decided by a majority of 4 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. So as you can see, there is good amount of convergence between market expectations and the RBI's policies. In other words, both market expectations and RBI policies, so far as monetary policy is concerned, are well aligned. I shall now briefly set out the rationale for these decisions. Headline inflation, after remaining steady at 4.8% during April and May this year, increased to 5.1% in June, primarily driven by the food component, which remains stubborn. While the fuel group remained in deflation. The expected moderation in headline inflation during the second quarter of 24-25, that is in the second quarter of the current financial year, on account of favorable base effects, is likely to reverse in the third quarter. This is something which I had also explained in the last monetary policy meeting in June, that in the third quarter we have a substantial advantage of the base effect, which may pull down the overall inflation numbers. But going forward, that base effect will wear out. Domestic growth, however, in these circumstances is holding up well on the back of steady urban consumption and improving rural consumption, coupled with strong investment demand. Amidst this confluence of factors, the MPC judged that it is important for monetary policy to stay the course while maintaining close vigil on the inflation trajectory and the risks thereof. Resilient and steady growth in GDP enables monetary policy to focus unambiguously on inflation. It must continue to be disinflationary and resolute in its commitment to aligning inflation to the target of 4% on a durable basis. Accordingly, the Monetary Policy Committee decided to keep the policy repo rate unchanged at 6.5% in this meeting. The commitment of monetary policy to ensure price stability would strengthen the foundations for a period of sustained growth. Now, this point needs to be appreciated, that ensuring price stability eventually results and supports a period of sustained growth. Without price stability, high growth cannot be sustained. So therefore, especially in a situation where our GDP growth is holding up well. We have decided to focus on inflation and ensure price stability, mainly to support growth. In these circumstances, the MPC reiterated the need to continue with the disinflationary stance of withdrawal of accommodation to ensure that inflation progressively aligns to the target while supporting growth. I would now like to provide an assessment of the growth and inflation conditions in India. But before that, let me briefly touch upon the global growth scenario. Global economic outlook exhibits steady though uneven expansion. Manufacturing is indicating slowdown while services activity is holding up. Notwithstanding sticky services prices, inflation is receding grudgingly across major economies. With varying outlook for growth and inflation across countries, monetary policy is showing signs of divergence across jurisdictions. Several central banks are cautiously moving towards policy pivots, though through forward guidance and rate cuts. While at the same time, there has been tightening by a few central banks also. So on the one hand, you have several central banks which are moving towards a rate cut scenario, but on the other hand, you have a few economies which are on a rate hike mode. Global financial markets are exhibiting volatility. Bond yields and the dollar index have softened since the last meeting of the MPC in June. While the near-term outlook looks positive, I'm talking about global growth. While the near-term outlook looks positive, there are significant challenges to medium-term global growth outlook. Demographic shifts, climate change, geopolitical tensions and fragmentations, rising public debt, and new technologies such as artificial intelligence pose new sets of challenges. A coherent policy approach in which monetary policy is complemented by other policies to manage the policy trade-offs will be crucial to deal with such multiple challenges. Let me now turn to domestic growth. Domestic economic activity continues to be resilient. On the supply side, steady progress in southwest monsoon, higher cumulative kharif sowing, and improving reservoir levels augur very well for the kharif output. The likelihood of La Nina conditions developing during the second half of the monsoon season is likely to have a bearing on agricultural production in the current financial year. Manufacturing activity continues to gain ground on the back of improving domestic demand. The Index of Industrial Production, that is IIP, growth accelerated in May this year. Purchasing Managers Index, that is PMI for manufacturing, at 58.1 in July remained elevated. Services sector maintained buoyancy as evidenced by the available high-frequency indicators. Now, when I say high-frequency indicators, I have given a lot of details in the footnote of my statement, which, as you would know, will get uploaded immediately my statement is over. In fact, for almost, most of the statements which I am making, there is a lot of backup data which we have given in the footnotes. So in the interest of time, I am not reading out that data, but it is there in the footnote. So when the statement is uploaded, I would encourage you to please have a look at it. Similarly, PMI services stood strong at 60.3 in July and is above 60 for 7 consecutive months, indicating robust expansion of services. On the demand side, household consumption is supporting a turnaround in rural demand and steady discretionary spending in urban areas. Fixed investment activity remained buoyant amid government's continued thrust on capex and other policy support from the government. Private corporate investment is gaining steam on the back of expansion in bank credit. Merchandise exports expanded in June, although at a slower pace. Expansion in non-oil, non-gold imports accelerated, reflecting resilience in domestic demand. Services exports recorded double-digit growth in May this year before moderating in June. Looking ahead, improved agricultural activity brightens the prospects of rural consumption, while sustained buoyancy in services activity is expected to support urban consumption. The healthy balance sheets of banks and corporates, thrust on capex by the government, and visible signs of pickup in private investment would drive investment activity in the current year. Improving prospects of global trade are expected to aid external demand. In fact, so far as external demand and the improving volume of global trade is concerned, all the international agencies have projected a good growth in global trade vis-a-vis the numbers that we saw last year, and the numbers are given in the footnote. The spillovers from protracted geopolitical tensions, volatility in international financial markets, and geoeconomic fragmentation, however, pose risks on the downside. Taking all these factors into consideration, real GDP growth for 2024-25, that is for the current year, is projected at 7.2%, with Q1 at 7.1%, Q2 at 7.2%, Q3 at 7.3%, and Q4 at 7.2%. Real GDP growth for Q1 25-26, and this is something which we are giving for the first time. Real GDP growth for Q1 of next financial year, that is 2025-26, is projected at 7.2%. The risks are evenly balanced. Now, it may be noticed that we have slightly moderated the growth projection for the first quarter of the current financial year in relation to the projection which we gave in the previous MPC in June. This is primarily due to updated information on certain high-frequency indicators which show lower than anticipated corporate profitability, central government, general government expenditure, and core industries output. Let me now turn to inflation. Headline inflation edged up to 5.1% in June 2024 due to higher than expected food inflation. Fuel remained in deflation for the 10th consecutive month. Core inflation moderated to a historic low in the months of May and June. Food inflation, which has a weight of around 46% in the CPI basket, contributed to more than 75% of headline inflation in May and June. Vegetable prices increased sharply and contributed to about 35% to inflation in June. High inflation pressures persisted across other major food items also, details of which are given in the footnote. On the other hand, the softening in core inflation continues to be broad-based, with core services inflation touching a new low in the current CPI series during the month of May and June 2024. The high food price momentum is likely to have continued in the month of July also. Large favorable base effects, as I said earlier, may however push headline inflation downwards in July. The impact of the revision in milk prices and mobile tariffs also needs to be carefully monitored. A degree of relief in food inflation is expected from the pickup in southwest monsoon and the healthy progress in Kharif sowing. Buffer stocks of cereals continue to be above the norms. Global food prices showed signs of easing in the month of July after registering increase since March 2024. Assuming a normal monsoon and taking into account the 4.9% inflation print which has already come out so far as Q1 is concerned, CPI inflation for the current financial year, that is 2024-25, is projected at 4.5%, with Q2 at 4.4%, Q3 at 4.7%, and Q4 at 4.3%. CPI inflation for the first quarter of next financial year, that is Q1 2025-26, is projected at 4.4%. The risks are evenly balanced. Now, I have given a brief analysis of the growth scenario and also the inflation scenario so far as Indian economy is concerned. Now the question arises, what do these inflation and growth conditions mean so far as monetary policy is concerned? Let me try and answer. As stated earlier, continuing food price shocks slowed the process of disinflation in Q1 2024-25. There is also considerable divergence between headline and core inflation. This has brought to the fore the issue of how much importance should the MPC give to food inflation. Let me dwell upon this in some detail. First and foremost is the fact that our target is the headline inflation, where food inflation has a weight of about 46%. With this high share of food in the consumption basket, food inflation pressures cannot be ignored. Further, public at large understands inflation more in terms of food inflation than the other components of headline inflation. Therefore, we cannot and should not become complacent merely because core inflation has fallen considerably. Second, and equally important, is the reality that high food inflation adversely affects household inflation expectations, which have a significant impact on future trajectory of inflation. Household inflation expectations, after witnessing a moderating trend between May 2022 and September 2023, have edged up on the back of high food inflation since November 2023. Persistently high food inflation and unanchored inflation expectations, if they materialize, could lead to spillovers to core inflation through pickup in wages on cost of living considerations. This in turn could be passed on by firms in the form of higher prices for services as well as goods, especially in a scenario of strong aggregate demand. Third, these behavioral changes can then result in overall inflation becoming sticky even after food inflation recedes. The MPC, to summarize, what these points which I was mentioning about the importance of food inflation and how high persistent food inflation can spill over to core and to the headline. Let me just summarize this part by saying that the MPC may look through high food inflation if it is transitory. But in an environment of persisting high food inflation, as we are experiencing now, the MPC cannot afford to do so. It has to remain vigilant to prevent spillovers or second-round effects from persistent food inflation and preserve the gains made so far in monetary policy credibility. Now, overall, as I have said in my statement, and as the numbers would speak, overall the inflation trajectory has been moderating, and we do expect it to moderate. But the pace of moderation has been uneven and slow. So therefore, we need to be watchful to ensure that we move to closer to 4%, and the CPI inflation gets aligned to the 4% target on a durable basis. That indeed would be the best contribution which monetary policy can make to support economic growth in the country. Liquidity and financial market conditions. This is what I would now like to focus on. System liquidity transited from deficit in June to surplus conditions in July. In tune with changing liquidity conditions, the Reserve Bank conducted two-way operations under the LAF to ensure that the interbank overnight rate remained closely aligned to the policy rate. Mirroring the liquidity dynamics, the weighted average call rate, that is WACR, on an average remained close to the middle of the LAF corridor. Across the term money market segment, the yields on certificates of deposit and 3-month treasury bills, that is T-bills, eased, while the yields on commercial papers remained stable. The 10-year G-Sec yield softened in June, July, and in August so far. The term premium has remained steady in recent months. Transmission in the credit market remains ongoing. Going forward, the Reserve Bank will continue to be nimble and flexible in its liquidity management operations, keeping in view the evolving liquidity conditions to ensure that money market interest rates evolve in an orderly manner. During 2024-25 up to August 7, the Indian rupee remained largely range-bound. The lower volatility of the Indian rupee bears testimony to India's strong economic and financial stability and an improving external outlook. In the last few days, global financial markets have seen turmoil on concerns of growth slowdown in a major economy, flare-up in geopolitical tensions in the Middle East, and the unwinding of carry trade. These developments have implications for emerging market economies. In this context, it would be important for market participants to keep in mind the strength of India's macroeconomic fundamentals, which remain robust. India has built strong buffers that impart resilience to the domestic economy from such global spillovers. The Reserve Bank remains committed to ensure orderly evolution of financial markets in its regulatory domain. Let me turn to now financial stability. The Indian financial system remains resilient and is gaining strength from the broader macroeconomic stability. Its well-capitalized and unclogged balance sheet is reflective of higher risk absorption capacity. The NBFC sector and the urban cooperative banks also continue to show improvements. Even in such stable financial sector conditions, the emphasis cannot shift away from proactive identification of potential risks and challenges, if any. In the current context, there are four issues which I would like to highlight. First, it is observed that the alternative investment avenues are becoming more attractive to retail customers, and banks are facing challenges on the funding front, with bank deposits trailing loan growth. As a result, banks are taking greater recourse to short-term non-retail deposits and other instruments of liability to meet the incremental credit demand. This, as I have emphasized elsewhere, may potentially expose the banking system to structural liquidity issues. Banks may therefore focus more on mobilization of household financial savings through innovative products and service offerings, and by leveraging fully on their vast branch network. It is the first point which I wanted to highlight in the context of the financial sector. You see, as I mentioned a little while ago, the overall financial sector continues to be healthy and stable. As the regulator of certain segments of the financial sector, it's our responsibility to point out the possible or the potential areas where risks may come up. And it's our responsibility to just suggest to the banks, to the NBFCs and other financial institutions to be extra careful and to keep extra vigil on certain aspects, which is not a problem at the moment, but if unattended, can become a problem at a later stage. But so far as the current scenario is concerned, and so far as the overall financial sector outlook is concerned, I would like to again reiterate and re-emphasize that India's financial sector remains stable and healthy. Now, in this context, the second point which I would like to mention is that the sectors in which preemptive regulatory measures were announced by the Reserve Bank in November last year have shown moderation in credit growth. However, certain segments of personal loans continue to witness high growth. Excess leverage through retail loans, mostly for consumption purposes, needs careful monitoring from macroprudential point of view. It calls for careful assessment and calibration of underwriting standards as may be required, as well as post-sanction monitoring of such loans. Most of the banks are doing it, but we need to constantly re-emphasize this point. The third issue that is attracting our attention is home equity loans or top-up housing loans, as they are called in India, which have been growing at a brisk pace. Banks and NBFCs have also been offering top-up loans on other collateralized loans like gold loans. It is noticed that the regulatory prescriptions relating to loan to value, that is LTV ratio, risk weights and monitoring of end use of funds are not being strictly adhered to by certain entities. I repeat, certain entities. Such practices may lead to loan funds being deployed in unproductive segments or for speculative purposes. Banks and NBFCs would therefore be well advised to review such practices and take necessary remedial action. Fourth, recently there was an unprecedented outage globally which affected businesses in many countries. The outage demonstrated how minor technical change, if it goes haywire, can wreak havoc on a global scale. It also showed the fast-growing dependence on big techs and third-party technology solution providers. In this background, it is necessary that banks and financial institutions build appropriate risk management frameworks in their IT, cybersecurity, and third-party outsourcing arrangements to maintain operational resilience. The Reserve Bank has time and again emphasized the importance of robust business continuity plans, that is BCP, to deal with such incidents and situations. Now I would like to focus on the external sector. India's current account deficit moderated to 0.7% of GDP in 2023-24 from 2% of GDP in 2022-23 due to a lower trade deficit and robust services and remittances receipts. In the first quarter this year, that is in the first quarter of 24-25, merchandise trade deficit widened as imports grew faster than exports. Buoyancy in services exports and strong remittance receipts are expected to keep the current account deficit within sustainable level in Q1 24-25. We expect current account deficit to remain eminently manageable during the current financial year. On the external financing side, foreign portfolio investors turned net buyers in the domestic market from June 2024 with net inflows of $9.7 billion during June-August, that is till August 6, after witnessing outflows of $4.2 billion in April and May. Foreign direct investment, that is FDI flows, picked up in 2024-25 as gross FDI rose by more than 20% during April and May 2024, while net FDI flows doubled during this period compared to the corresponding period of the previous year. External commercial borrowings moderated during April-June in the current financial year, while non-resident deposits recorded higher net inflows during April-May compared to the previous year. India's foreign exchange reserves, this is something worth noting, India's foreign exchange reserves reached a historical high of $675 billion as of August 2nd, 2024. Overall, India's external sector remains resilient as key indicators continue to improve. We remain confident of meeting our external financing requirements confidently. Now there are certain additional measures. There are 5 of them, and I would like to announce them quickly. First relates to public repository, that is creation of a public repository of digital lending apps. The Reserve Bank has taken several measures for the orderly development of the digital lending ecosystem in India. As a further measure in this direction and to address the problems arising from unauthorized digital lending apps, the Reserve Bank proposes to create a public repository of digital lending apps deployed by the regulated entities. The regulated entities of RBI will report and update information about their digital lending apps, that is about the digital lending apps whose services they are availing in this repository. This measure will help the consumers to identify the unauthorized lending apps. The next announcement relates to frequency of reporting of credit information to credit information companies, that is CICs. The availability of accurate credit information is vital both for lenders and borrowers. At present, lenders are required to report credit information to CICs on a monthly basis or at such shorter intervals as may be agreed between the lenders and the CICs. It is proposed to increase the frequency of reporting of credit information to the CICs to a fortnightly basis or at shorter intervals as may be agreed between the lenders and the CICs. Consequently, borrowers will benefit from faster updation of their credit information, especially when they repay their loans. The lenders on their part will be able to make better risk assessment of the borrowers. The next announcement relates to enhancing transaction limit for tax payments through UPI. Currently, the transaction limit for UPI is rupees 1 lakh, except for certain category of payments which have higher transaction limit. It has now been decided to enhance the limit for tax payments through UPI from rupees 1 lakh to rupees 5 lakh per transaction. This will further ease payments by consumers through the UPI. Next announcement relates to introduction of delegated payments through the UPI. It is proposed to introduce a facility of delegated payments in the UPI. This would enable an individual, that is a primary user, to allow another individual, namely a secondary user, to make UPI transactions up to a limit to be set by the primary user from the primary user's bank account without the need for the secondary user to have a separate bank account linked to UPI. This will further deepen the reach and usage of digital payments, in particular the UPI. The next announcement, and that's the last announcement, which is very important, is continuous clearing of checks. This is something which will have wide-ranging impact, and it's a step towards having greater ease of doing business for individuals as well as for entities. At present, check clearing through check truncation system, that is CTS, operates on a batch processing mode and has a clearing cycle of up to 2 working days. It is proposed to reduce the clearing cycle by introducing continuous clearing with on-realization settlement in the check truncation system. This means that checks will be cleared within a few hours on the day of presentation itself. This will speed up check payments and benefit both the payer, that is the drawee of the check. So this will benefit both the payer and the payee. Now let me try and conclude. I have provided broad analysis of the inflation situation, the growth inflation dynamics. Then I have highlighted on the financial sector, I have highlighted on the external sector, and I have also made certain announcements, and I now proceed to conclude. As I said, inflation, I just repeat it for the sake of putting things in perspective. Inflation, that is headline inflation, is moderating, but the pace is uneven and slow. Therefore, we need to be watchful, and we are watchful of the inflation scenario. We are also watchful of the growth trajectory, and both of them appear to be moving in a very balanced manner. Financial sector remains stable. Our external sector also remains stable. We have built up substantial buffers which will, which makes India much more resilient than what it was years ago. Now on the current, so let me now try and conclude. Under the current monetary policy setting, inflation and growth are evolving in a balanced manner, and overall macroeconomic conditions are stable. Growth remains resilient, inflation has been trending downward, and we have made progress in achieving price stability. But we have more distance to cover. The progress towards our goal of price stability has been uneven due to large and persistent supply-side shocks, especially in food items. We therefore need to remain vigilant to ensure that inflation moves sustainably towards the target while supporting growth. This approach would be net positive for sustained high growth. We recognize the challenges along the way, but we have to be patient to finish the job at hand. In the current context, the following words of Mahatma Gandhi are highly relevant, and I quote, "The slightest error of judgment," I repeat, "the slightest error of judgment, a hasty action, or a hasty word may put back the hands of the clock of progress. Policies have therefore to be cautiously evolved." Thank you. Namaskar.
Well, hi guys, welcome to this Moneycontrol live stream. There you heard the governor, talk about inflation management, how it is at the center stage, and a job that has to be managed, and it requires a lot of patience as well. Stuck to the script in terms of headline numbers. Repo rate has been maintained at 6.5%. Stance remains withdrawal of accommodation, 4:2. That is the kind of voting that came in favor and against the stance. Of course, two members have been consistently, voting for a neutral stance. That hasn't happened, and I really couldn't find any indication of that happening in the October policy as well. But aside of that, growth projections have been maintained, but some tweaks in the quarterly forecasts. Same for inflation as well. For the second quarter, it has been bumped up by 60 basis points for the third quarter as well. But overall, it has been maintained at 4.5%. Of course, the governor did take note of global challenges on a medium-term basis. But the talk really focused on inflation management and how food inflation has been inching up. And, a lot needs to be done to tame that as well. But in terms of dovishness, Stacey, I really couldn't find anything, that was suggesting that, in the light of what is happening globally. Because mind you, last policy to this policy, in fact, in the last 1 week, things have changed dramatically on the global front, right? And we were hoping that the governor would sound a little dovish in the wake of that. But the message is clear. It's the focus right now is on inflation management, and it will continue to be so till the time inflation is actually aligned to the target of 4%.
Absolutely. In fact, we've been talking about this, in context with what is happening even in the US, and there were these talks because of how the markets have been reacting. And in fact, our markets also did see, while the governor's speech was on, we did see the little bit of blip continuing to see that selling pressure. But overall, there was this talk of, in the US, an off-cycle kind of rate cut. Those have been, rumors have been put aside of sorts. But you can say that similar here also, the governor is in no hurry. He wants to make sure that inflation is got on track, that they come to those target levels, and only then they would be looking at, even tweaking. And he says that mainly in order to support growth is what his backing is of this. But in terms of the numbers, like you said, just a few tweaks that were made, of course, in the inflation projection as well as in the GDP number that we are seeing for Q1 FY25. That one was earlier at 7.3%, which has been reduced to 7.1%. Pretty much all the other quarters, they have stuck to the what they had forecasted earlier, and the FY25 projection also remains at 7.2 for FY25. That is the real GDP growth that the RBI sees. But let's get discussing with our guests who are waiting by as well. Joining us now is Aditi Nair from ICRA as well as Nirav Karkera of Wisdom. Thank you both of you all for giving us your time and speaking with us here at Money Control. It's become kind of repetitive for Nandita and me for the past 8 bi-monthly policies that we've been saying. That it is something that status quo has been maintained, and we are the governor is not really going to give us any surprises. But Aditi, coming to you first then, how are you reading this? And obviously we've been saying he's been sticking to the script, but anything Nandita that really stood out for you from the governor's speech, Aditi?
We were very much expecting that there'll be no change in the stance or the rates or the inflation target. And I think three kind of surprises for me. One, I did think that the overall GDP target would be reduced, and we only got a little bit of a tweak. I still think that the Q1 GDP growth number is going to be 6.5% or less. So there is still a wide variation between at least what my forecast is for Q1 versus what the MPC is saying. And because they still have, this conviction that growth is going to remain above 7% for the next, they've sounded a lot less dovish, or rather more hawkish than I expected them to. I did think that some cues that growth would be softer in H1 may lead them to putting forward a more sort of dovish tone as a precursor to the stance being changed in October. But as of today's policy, there is no hint that that's going to happen. And unless we do have a significant downside in the Q1 GDP growth number, which we'll get in a couple of weeks, as compared to what the MPC has said today, the bar for stance change in October is looking really, really high. So, not sure if global events will be enough to really push a stance change in October, unless growth disappoints relative to what the governor said today. And I think the last thing that I just want to mention in terms of a surprise is very early on in the speech today, the governor went ahead and talked about how the RBI's views and the MPC's views are very aligned with the market. So I'm not sure when I last heard a comment like that in the governor's speech on MPC day at least.
Right, Aditi, do you feel that inflation is still aligned to the 4% target despite high food inflation, or is it being offset by a crack in global commodity prices? What are your thoughts?
My thoughts are that food inflation remains uncertain in terms of the outlook. A lot is riding on the second half of the monsoon season being favorably distributed and non-disruptive. And in general, looking at where we are over the medium term, agroclimatic issues are going to remain a challenge for securing low food inflation, especially in the Indian context where we have still a lot of dependence on the monsoon being well distributed, and where we expect that domestic consumption is really going to drive our growth. My sense is that even things like services inflation are going to remain something that we need to be very watchful of going ahead. I don't think the battle on inflation is won. I think every year keeping inflation under control is going to remain a policy imperative. And a lot of what the governor said today resonates with that. It's just that I did expect that because there are indications that the Q1 growth is going to be a little softer, that the tone would have been a little more tilted towards the dovish side, which didn't turn out to be the case.
Right. Of course, also joining us is Nirav Karkera of Wisdom. Nirav, my first question to you, how are you reading into the commentary? Because, there is no sign or hint of dovishness as the street was anticipating against, the global backdrop, which has turned extremely volatile. Do you think that came as a big disappointment? Because we did see quite a sharp drop in the middle of the RBI governor's speech, both on the Nifty as well as the Nifty Bank Index. We know that Nifty Bank has been underperforming, right? The banking lot has been underperforming. Just about yesterday, we saw that 50,000 mark come back on the charts. But how is it looking like? I mean, what are your takeaways, and what is it that disappointed you the most from the governor's speech?
can't hear. So
Neerav, are you able to get my audio?
I think there's some audio
Okay, I think
issue,
we have, we're facing that problem with Nirav, but perhaps Aditi can only come in and, give us her take on how you did mention about how inflation is going to be this real big focal point, and of course, the RBI governor also time and again saying that. But Nandan, we were just having this chat before this about, how the US recession and those fears were the one that really jittered the markets as well at the start of this week. Are there those kind of concerns that can also be a part of our markets here? In terms of, all the macros have lined up pretty well for India, but what could be those other factors that could then be those pain points?
Globally, I think we're in for 3 to 6 months of a lot of uncertainty in terms of what happens in the US elections and then the fallout of that for a realignment of geopolitics. So this is stuff that is going to keep global markets jittery, and sentiment is going to be a little nervous, especially in the run up to the US elections in December. Now, what is the fallout of that or the implications of that for commodity markets? I think that is something that we need to wait and watch. One of the reasons why the Q1 GDP forecast was lowered a tad by the MPC today is because the margins of the listed corporates have not been as healthy in Q1. And that is something that we were expecting based on where the commodity prices were on a YOY basis. Now, going ahead, if sentiment turns so nervous that we have a fall in commodity prices, which is sustained over the next quarter or two, then perhaps that will have a different implication as far as the margins are concerned, and it may help to actually buffer domestic GVA growth, especially for the manufacturing sector, if the domestic consumption remains intact. Now, one more thing that we've been kind of thinking about is that the big if, and the governor said it as well, assuming a favorable monsoon. Now, if the rest of the monsoon season is favorable, well distributed, or on a time basis, on a geography basis, we don't have any instances of very heavy rainfall over a short period of time, which is quite disruptive now because a lot of the sowing is done. And we are looking at the crop being quite immature and maturing now. The gestation will happen over the next few months, couple of months till the harvest. So if there are no such disruptive periods, and if we end up with a good Kharif harvest, the cash flows will coincide broadly with the festive season. In that event, we may actually end up with a good amount of pent-up demand coming in from the rural sector. And that would push up the growth forecast for the second half of the year. So I think there are lots of uncertainties, both from the global front and the implications of that, as well as the monsoon on the underlying demand strength in the Indian economy. So a lot of data to wait and watch for. Over the next 8 weeks, also we'll have possibly a lot more clarity in terms of what the Fed is expected to do. As I said earlier, I think the bar is still pretty high to get a stance change in October itself. We'll get a better sense of whether that is likely after we get our own GDP data at the end of this month.
Right, Aditi, since the start of the year, the rate cut forecast for the US at least have been going haywire. We started off with 5 to 6 rate cuts this year, came down to 125 basis point rate cut in September, but now the last 1 week things have changed so dramatically after cracks appeared in the US jobs market that now we are working with a 125 basis point rate cut this year itself, right? In that sense, a 50 basis point is a given in September. Would you say that? And of course, market has ruled out an out of cycle high cut by the Fed. Would you concur with that? And would you also see a 125 basis point kind of rate cut in the US this year itself?
Out of cycle means a central bank is panicking. It means that there is a massive shock which was unanticipated, and I don't think anybody wants to suddenly be in a position where they're admitting that things are that stressed out. My sense is no outer cycle. September, if the data up to then is really looking bleak, maybe we kick off with 50. Or if the data is not unequivocally pointing towards a downturn, then maybe we'll just kick off with 25. My sense is we're not going to get more than 75 basis points of cumulative cuts from the Fed before they go into some wait and watch mode to really assess the implications of the rate cuts on inflation. So 75 between possibly September and December, and then a pause is my sense of the baseline at this point in time.
Right, Aditi, since we're talking about the US rate cut, in fact, our sister networks had done a poll of saying how soon could we be seeing anything like that here. And there were murmurs at least of possibly seeing something by December, rate cut by December. And you were just talking about, how RBI is, maybe the next policy is when we could see a change in stance. And then by December, would you agree with that? Or do you have a different kind of timeline that you're looking at?
So before today's more hawkish than expected tone, our baseline was a stance change in October and a 25 basis points rate cut each in December and in February. I would say that to some extent the probability of this timeline has gotten shifted by a policy each. But we'll have to wait and see and reassess really after we get the GDP data on the 30th of August, whether stance change is likely in October or is it getting delayed to December. And subsequent to the stance change, we would expect 25 basis points each of rate cuts in the next two policies before we then go into an extended pause.
Right. Well, thanks so much, Aditi, for speaking with us and helping us understand what we could expect and when that timeline for the rate cut that we could look forward to. But thanks so much for speaking with us here at Money Control.
I think Nirav is joining us now. Nirav Karkera from Fisdom. Nirav, great to have you on the show. I think we have lost him again. I think.
Well, let's just talk about the markets and how those have been reacting.
Let's just
for that matter, right now.
Take a look at the markets. We have recovered from the low point of the day, although it is still a 100-point cut on the Nifty. The mid-cap index, surprisingly, is holding out. It's in the green, 0.2% kind of gains coming in there. But the knee-jerk reaction that came in the middle of the governor's speech, we've recovered some lost ground from there. Yeah. The bank Nifty is still a little iffy. It's it's flat with a negative bias. But I think Nirav is back with us. Nirav, hi. If my voice is reaching you, we did see quite a blip come in when the governor's speech was on. The Nifty slumped to the day's low, but we've recovered some lost ground, although we are seeing a triple-digit cut on the index. But what is it that disappointed you the most from the governor's speech? Because there was no hint of dovishness, no signal of a stance change in October that the street was actually hoping for. So the focus was more on inflation and inflation management.
Namita, I'm so sorry. I can barely
hawkish, so to say.
hear you. Can you hear me? Is my audio clear?
I can hear you, Nirav. Yes, your audio is clear to us.
But I can't
tell us
quite
what's
hear
your
you
takeaway
very
been?
clearly. I'm sorry, I can't hear
okay,
you.
if in case my voice. Okay.
No, I mean I can.
No worries, then
Your
we'll
voice.
try and fix this. Right. Just tell us what your takeaway has been from the governor's speech.
Okay, yeah. So the key takeaways are basically that nothing has changed. Of course, life remains as is. However, there are a few Easter eggs that the governor has left in its speech. In fact, it has highlighted a few critical pointers, that one must take note of, and that will set the tone for the next upcoming. MPC meet. For instance, the governor impressed a lot upon the fact how deposit growth is not growing in tandem with what one would expect at this point in time, and also how food inflation is persisting a whole lot more than initially anticipated, right? So these couple of things are they sort of set, they are sort of indicators on what one could expect going ahead. Of course, today's MPC announcement itself was non-event, but there was a lot of similar indications. Also, as we one thing that came out very clearly, that the governor remains very hawkish inflation, and even within the inflation maintains a very strong stance on not letting the rope too loose, especially when it comes to food inflation. Right. At the same time, he also spoke about how there are higher than average rainfalls in certain areas, but at the same time, it is worth noting that the El Nino effect could lead to several crop losses, and at the same time, major food grain producing regions are not witnessing as healthy rainfalls as it should. So in certain areas, we are witnessing excessive rainfalls. That's also unhealthy, and we are witnessing a deficit that is also rather unhealthy. So both of these together will exert a lot of pressure on food prices going ahead, and leading to persistently stickier inflation, majorly on the back of this 45-46% food inflation that it carries, the weight that it carries in the total inflationary basket. Apart from that, I feel it is very clear that the governor will have, or the RBI, the Monetary Policy Committee, will have its eyes on domestic cues much more than global cues, because while there may seem a global unwinding of the tightening regime, but at the same time, it is not really in unison, and it is highly uneven. So, in such a situation, we can expect the central bank to continue looking inward and not outwardly before deciding their next steps. So, yes, the key important takes is food inflation, hawkish view on it. At the same time, banking system liquidity and deposit growth, the second thing to look out for. And third, while the external macros may exert some pressure and build the case for a rate cut in India, the central bank may not just completely take that into account, but also account for these domestic factors before kickstarting the next round of rate cuts.
Right, so it is pretty much that seesaw. Nirav, do stay on with us. We also have Dr. Manoranjan Sharma, Chief Economist at Infomerics Ratings, who's joining us. Good morning, Mr. Manoranjan. How are you reading today's policy? It's the 9th consecutive time that we've been maintaining status quo. Nothing much has changed. In fact, the other economist that we are talking to says that it didn't have any of those dovish feelings that we thought we would see, we would hear in that commentary. It's pretty much just status quo all in all. How would you be reading this?
Well, thank you, ma'am. I think, am I audible? Ma'am, am I audible?
Yes, sir, you can go ahead.
Am I audible? Yes. Okay. Well, we think it's contextually a significant policy. This may have been the 9th consecutive policy in which there was no change either in the stance or in the repo rate, but then, especially in the repo rate, but then given the kind of macro environment that we have a steady growth of something like 7%, but inflation is on a downtrending kind of a movement, but food inflation continues to be a major concern. It has been turning out to be somewhat sticky, not moving down, and maybe this thing could persist for some more time. Apart from that, there are also geopolitical factors, volatility in the financial markets, some upward movement, downward movement in the stock exchange. We also have geopolitical tensions between Israel, Hamas, Ukraine, Russia. So on the whole, even though the RBI governor or the MPC goes in for some kind of a trade-off between growth and inflation, I think I'm reminded of an American phrase, if it aren't broke, don't fix it. So given the kind of macroeconomic situation that we had today, I think it's a contextually right call.
Right, Nirav, coming to you once again, just want to read out one concern area that RBI has highlighted. Top-up housing loans have been growing aggressively, and banks have been offering such products. Such funds are being deployed for speculative purposes. We've already seen quite a lot of crackdown by the RBI, right? The likes of IFL Finance and etc. But do you see some bit of crackdown coming in this area as well?
Segment has been growing at quite a fast clip, and also, when with most other facets of the economy, also when something really starts growing at a really rapid pace, there is a case for at least investigation that is made. Right, you want to ensure that in the bid to move fast, you're not breaking a lot many things. So, like you rightly said, RBI has been very critical about the fast-paced growth in the housing loan book, and there have been crackdowns, but I won't really call it a systemic crackdown. I believe the central bank has been very calibrated and has been very measured in its approach on clamping down on certain issues that have been arising out of the swelling housing loan book. So even going ahead, I believe this is not going to be the general stance of the central bank. I feel that there is enough buoyancy in the segment. I believe the stance that the central bank would rather adopt is that of guard railing and cautioning stance, much more than a clampdown sort of a situation. So it would be highly it would be under high surveillance and scrutiny, but not restrictive in its approach. So that's the way we maintain our outlook on the housing loan segment, and we believe structurally, it is set for larger leaps of growth. But at the same time, the central bank and several other participants by the government will ensure that the growth is not just erratic, but much more structured and healthy and sustainable in a manner. So, going ahead, we believe that the RBI will continue to take cognizance of fracture and fault lines in the system and try to, proactively take, reparation measures and ensure that this segment of the economy grows in a sustainable manner.
Mr. Sharma, if you can hear me, maybe just an extension to what we were asking Nirav, and this whole challenge of banks and of them raising deposits. And you also heard from the likes of an SEBI chairperson say concerned about where the savings are really going, whether they're moving into markets, and that is a very worry, and which is why banks could perhaps be seeing some liquidity issues. Is that a concern? Do you think there is reason to be worrying when it comes to a situation like that?
Yes, certainly. I agree with it. It's a certain, there's an area of concern, but possibly not of alarm. If you look at the banking transactions in a proper historical and comparative perspective, what we find is traditionally advancing loans, giving loans and advances has been the more tricky part. But now we are finding that for last several months, credit growth in India of the banking system, what the RBI calls scheduled commercial banks, this has been outpacing the growth of deposits. So I think recently the RBI governor also referred to this issue of which has led to some kind of a mismatch in the asset and liability system. On our part, we have been flagging this issue for quite some time, at least for 6 to 8 months. One of the primary reasons is there are two, three reasons. One, of course, is still the rate of inflation hovering around something like 5%, even if you take the retail inflation, CPI inflation. But apart from that, a more fundamental factor accounting for this kind of a paradigm shift, where the focus is shifting from loans and advances to deposits, is the fact that if you look at the last 12 months, 16 months, the mobilization in the stock market through the SIP route, systematic investment plan route, has been of the order of something like 25,000 crore rupees a month. So if you extrapolate it on a yearly basis, it works out to a humongous 3 lakh crore. What is of greater concern that given that stock market is booming, is zooming from one level to another. Last month, the SIP mobilization was something like 40,000 crore for a single month. So if you have SIP mobilization of that kind of money, if you have stock money flowing in the stock market, obviously deposits, because people have limited disposable income and surplus income. So there are limited avenues for the surplus to move from one bucket, so let's say deposits, to the stock market kitty. So obviously, when the SIP is growing at such a fast pace, obviously deposits will take a hit. Banks are trying to induce depositors by offering some higher rate of interest, offering some other kind of freebies attached. So let's hope that this too shall pass.
Okay, let's hope this too shall pass. But let me come to Nirav then for one last question. Nirav, we saw a good recovery in the market yesterday. Of course, that was on the back of a good recovery on Wall Street the previous night, right? But once again, yesterday we saw the US market couldn't really hold on to gains, and we ended with the cuts of somewhere around 1% on Wall Street. But going forward, do you expect volatility to remain or to be the name of the game? Because there are certain data points that are hinting at cracks in labor markets, but aside of that, you have US GDP growth that was strong, you have inflation also, core inflation at least, cooling quite a bit. So are the recession worries going to continue? Will that be an overhang? And secondly, do you expect the markets to remain in this no man's land kind of situation for the next at least couple of months, until September at least?
So, Nandita, what we saw was a culmination of various events, right? Of course, we all know about the Japanese yen carry trade unwinding that triggered a lot of this. But at the same time, like you rightly said, the inflationary data in the US could be indicating, optimism at this point in time. But, there are also several, lines of fractures in the entire system. Like if you look at the employment data, you'll see that does not reflect much enthusiasm, neither optimism, in the US context. And also, the case is being built for an off-cycle rate cut also. I'm not saying it'll happen, but there is a case that is solidifying as we speak, right? So the economy is not even very close to what the US Fed would like it to be at, right? So of course that is also a problem. But at the same time, we have several quarters of geopolitical crisis also coming into play at the same time, which will have a ripple effect on energy prices and the fiscal situation here in India, of course, because of our sensitivity to energy prices. Now, this coupled with domestic concerns, creates a perfect recipe for what could be called as a storm of volatility. One saving grace is the retail inflows. I'm sure that this is something that has been spoken about time and again, but this is in fact the only saving grace at this point in time. So there are two facets to retail inflows. One is the domestic institutions have been sitting on a lot of cash, for the longest time now, for since quite a few months, even quarters now. So that is being deployed strategically into the markets and is making up for all the FII outflows to quite an extent. At the same time, there is fresher influx of of domestic retail investors coming in. In fact, from the market standpoint, there's a small excerpt from the governor's speech that remains heartening, is that retail investors and households are viewing alternate sources as better opportunities to deploy savings and investments versus traditional deposits. And we know that among these alternative sources, capital market and capital market linked products rank pretty much high. So we are seeing a sustained flow in terms of MF inflows, SIP inflows also. So this remains a saving grace. However, the undercurrent remains really stormy and unpredictable. I'd say at this point in time, the volatility index has really surged to higher levels. There is also a sense of weakness, underlying weakness, that is being formed in the market, and you will view this in various quarters of the market as well. So going ahead, I won't be surprised if volatility remains the theme, and being smart and nifty about Nifty would be a smarter approach towards markets. I feel it is no longer a secular momentum driven market, at least not for a couple of quarters at least. Volatility will remain the theme, and there will be bouts of weakness, either coming from domestic facets, the likelihood of which is slightly less at this point, but more so from external global risks emanating and spilling over into the Indian economy and Indian markets context.
Absolutely. In fact, if you have to just summarize what the governor has done today, it is just status quo, and which is what we've also been repeatedly saying time and again. So let me take this opportunity to thank both our guests, Dr. Manoranjan Sharma as well as Nirav Karkera, for giving us their time and helping us understand what we are likely to expect now. Hopefully, from the next RBI policy, we might get a chance to say that things are different, or maybe a change in stance at least is what we are expecting, and perhaps the rate cut wishes come post that in December. But thank you so much, gentlemen, for giving us your time and speaking with us. Two other important things that the governor did mention, which is perhaps help Aam Aadmi, is the increase in, they've raised the transaction limit for tax payment through UPI from 1 lakh to 5 lakh, and they've done that earlier for a couple of other instances also, if you're paying your school fees and for hospital payments. So similarly, now if your tax transactions are more, that limit has been increased from 1 lakh to 5 lakhs, and the clearing cycle for checks, that has been reduced also from 2 days. The governor goes on to say that it will be done in a couple of hours from presenting a check. So I guess people will get their money sooner in their hands from now on. But that was pretty much what we had from the bi-monthly policy by the RBI. We'll be back with more updates and details. For all your other updates on business and finance, come back to moneycontrol.com as well as the Money Control app. For now, it's a goodbye from me as well as Nandita.
Thanks a lot for watching.